Okay, good morning, students. And today is 31st of December 2020, the last day of the year. And we are covering the subject strategic financial management. And the topic which we are covering is foreign exchange exposure and risk management. Today is the third lecture. We have covered, most of the basics. And today I'll be covering some more, topics. And I'm your faculty, CA Pravesh Agi, who will be taking you through the lecture. So let's begin. We were, covering this topic, exchange rate determination. There was some exercise which was left, so we'll start with that today. So straight away we start with a question, okay, which I think is from your practice manual. So let's begin. Now, in this question, it is given that the spot rate of US dollar is 48 rupees. The figure is given to you. It is 48.0123. So the spot rate is given for US dollar. Now, this is a pretty old quotation. Then 180 days forward rate for US $1 is 48.8190. As you can see, the dollar is appreciating on 180 days forward rate as it happens because the interest rates in US are low and in India they're high. So normally the forward rate will be always giving a appreciated value. Now, annualized interest rate for 6 months rupee is 12%. So India, the annualized rate of interest is 12%, and annualized interest rate for 6 months in US is 8%. Okay, so these are the annual rates which are given to you: 12% for India and 8% for US dollar. Is there any arbitrage possibility? If yes, how an arbitrager can take advantage of the situation? If he is willing to borrow rupees 40 lakhs or US dollar 83,312. So the question says that, is there any arbitrage possibility? If yes, how can he take an advantage? Now, in the last lecture we covered that the currency which has a low interest rate will always command a premium. Okay, here the premium is already there because the spot rate is 48.01 odd rupees, and the forward rate is 48 rupees and 81 paisa. Okay, so there is a premium which is showing up in the question. So let's understand this. Let's find out what is the forward premium. So we know that the formula is forward rate minus the spot rate divided by the spot rate. So we take the forward rate, which is 48.8190, minus the spot rate, which is 48.0123, and divided by 48.0123, which is the spot rate. And then because this is a 6 months rate, forward rate, so we'll do 12 by 6 into 100 to calculate the percentage of premium. So which comes to 3.36%. Now, if you see, the interest rate in India is 12% and America it is 8%. So the interest rate differential is 4%. So that means the dollar should have appreciated by 4%, but it has appreciated only by 3.36%, which means that there is the chance of arbitrage. Since the dollar has not appreciated to the extent interest rate differential, there exists an arbitrage opportunity. So which says that because since the dollar has not appreciated by putting the money in India, and then he gets 42,40,000 at the year end. So after 6 months, sorry. So after 6 months, he's going to get. So he says the video is paused. So I'm just going to check that. Okay, no, the video is okay. Fine. So the total amount at the end of 6 months will be 42,40,000. Now, when he brought the money in India, at the same time, he is going to take a forward cover because the forward rate is mentioned at the time of spot rate. The forward rate is also mentioned, which is 48.8190. So he is going to convert the same at the forward rate. So that means, while he knows that he'll be getting 42,40,000 after 6 months. So he's going to enter into a forward contract with a bank to take this money out of India. Okay, at the time when he brought the money in India. So that means he's going to get 86,851 rupee $0.43 after 1 year. Okay, so since the money is gaining to 42,40,000, so he has taken a forward cover or a forward rate contract. He has entered into a forward rate contract with the bank at the time when he brought the money into India, so that he knows that while his money will grow, he will take back amount which will be far exceeding, because it will carry an interest also, and at the forward rate he's going to convert that at $86,851.43. So now you can just see that the amount which is to be repaid after 6 months is $86,644.48, but the money which will get converted after 1 year will be $86,851.43. So which means he is going to make a profit of 206.95. Okay, so if we convert that into in Indian rupees as per the forward rate, assuming that the spot rate at the end of the 6 months will be 48.8190, so he is going to gain 10,000 rupees by simply bringing the money into India. Okay, so why this has happened? Because the dollar has not appreciated to the extent of 4%. Okay, and it has appreciated to the extent of only 3%. So it makes sense to borrow abroad and bring the money into India and invest that money in India. So we'll find that you will be a gainer. And then as a step, you just immediately, when you bring the money into India, you book a forward rate contract with the bank to take back, to convert the dollars into rupees, convert the rupees into dollars at the end of the year, end of the 6 months, and take the money back into home currency, which is dollars. So you'll find that there is a gain of 206.95 here. Hope you have followed it. Okay, so this was discussed in the last lecture, that how an arbitrage opportunity exists and how it can be encashed by the arbitrager. So in this case, it was a normal arbitrage opportunity where by putting money into India, borrowing from say US and investing in India, and then taking it back after 1 year or after 6 months in this example at the forward rate. So you'll find that in this process he's going to make $206.95. So this is actually a riskless profit in the hands of an arbitrager, because he is doing all these things in the step number 1 at the beginning of the year, at the time when the contract is entered. He's converting the dollars into rupees and then entering into a forward contract the same time with the bank, and he is assured that he'll be getting a gain at the end of the period. So he gets 206. So this is a riskless profit in the hands of arbitrators. So the arbitragers will keep doing it as long as they make money, until the dollar appreciates to its fullest extent to the 4%. Okay, so till the time the dollar appreciates to the extent of 4% by 4%, this activity in the market will be happening. Okay, so fine. So what we'll do now, we will of course you can just try to solve this question of your own. Okay, so there's yet another question which is given, which is based on the current rate which is prevailing in the market, almost similar to that. So which is a spot rate is 74.8325, and 180 days forward rate is 75.92, and the interest rate is 6% in India and 2% abroad. So is there any arbitrage possibility? If yes, how an arbitrager can take advantage of the situation if he is willing to borrow 50 lakhs or 66,816? Okay, so you can just try to, okay, it's working. Yeah. So this is the question which we are doing basically. Diksha, we just did a question. So we are just now doing an exercise which you people can do it yourself. Okay, so I put the question on the board, and the slides of course are already with you. Okay, so this was exercise number 5 which we did just finished, and now we are on the exercise number 6. Okay, so I'll just show you the answer. Okay, that of course the interest rate differential is 4%, whereas the forward premium is reflecting 2.906%. So there is an arbitrage opportunity. So he'll do the same thing which I have explained. I'm just going to keep the numbers here, so you can just jot it down. So he makes a profit of $350.56 by doing an arbitrage opportunity by borrowing from US, then converting that dollars into rupee and investing for 6 months at a rate of 6%, and then converting the same money which after 6 months into dollars back again, so entering into a forward contract with the bank and taking back money back to in US dollars. So he finds that he will be a gainer to the tune of $350.56. So which if translated at first the forward rate comes to about 26,614. So this is the money he's going to make in this question. Okay. So you can just try to see. In the meantime, I move on to the next chapter. Okay. So we have finished this exchange rate determination. So now I'm going to, go to your next this thing. So so in the meantime, if you have understood, so please tell me yes. If not, then I can explain it somewhere again. Okay. So since we have moved on to the next this thing slides. Okay. So we are going to understand today the most important one, foreign currency exposure risk. Okay. So a lot of questions in your exams come from these topics. So we are now entering into arena, which is going to be more interesting and more focused towards your exam, because a lot of questions we'll be doing now. Okay. So I hope you are able to, yeah, fine. So let's start with that. Now, who are the market participants in the foreign exchange market? You remember in the first class we did that. So there are people like banks. They exchange currencies as per their requirements of their clients. So they either do transactions on their own behalf in the currency market, or they exchange currencies as per the requirements of the clients. Now, clients may ask for buying the foreign currencies, or whenever they are doing exports, they're receiving dollars, so they want to convert their dollars into the home currency, okay, or the foreign currency into the home currency. So the banks does their job of dealing for their clients. Then the non-banking entities. Now, who are them? Multinational companies. They exchange currencies to meet their import or export commitments. So they may have export and import commitments, or hedge their transactions. So sometimes they need dollars, or they need foreign currency immediately, or they want to sell the foreign currency. So they approach the banks, or they can even hedge their transaction by entering into a forward contract with the bank. Okay, so these are the non-banking and non-bank entities. Of course, they can go to the futures market and options market. They can go to the forward market to hedge their transactions. So these are the people who are the non-bank entities, and we'll be covering all those topics: the futures, options, which are more interesting, and there are a lot of questions being asked on this topic. So we will be covering that later. So then there are speculators, the people who take either a long or short positions without any underlying exposure. So which means that they don't have either any imports or exports or any business transaction, but they are speculating on the currency. So either take a long position. Okay, if they expect the foreign currency to rise, suppose they expect the dollar to rise versus rupee, so they will go long on dollars. And if it happens, they make money. Or if they expect the dollar is going to depreciate or weaken against the rupee for a short while, then they can even short dollars, or they can even short rupees if they want. And if it happens, it goes in their favor, they make profits. Okay, so they get just a gain or loss out of these transactions and nothing else, because they don't have any underlying position. So they are not interested in hedging, but they are interested in making quick profits or gains. Now, the third category, which is arbitrages. And you remember that we have spent almost last class on understanding the arbitrage. Okay, so they make profit from the price differential. The profit, the differential between the spot rate and the forward rate. If they find suppose we talk about rupee dollar, if the dollar has not appreciated to the extent at the interest rate differential, so they will enter into the arena and start borrowing from in dollars and investing in Indian rupees. And if suppose the dollar has appreciated to a higher extent compared to the interest rate differential, they will do the reverse arbitrage by borrowing from India and taking the money abroad and investing in US dollars and making quick money. And they make a riskless profit in these transactions. Now the last one is the government. Now all the governments, they through the central banks like India RBI, they either enter into foreign currency transactions because they require foreign currency, or they want to sell foreign currency. But one of the main job is stabilizing the exchange rate. So because they don't want too much volatility and may hurt other participants. So they would like to stabilize the exchange rate, that is no big shock which is happening in the market. So India RBI, and in America like the Federal Reserve, so they are always trying to calm down the markets and stabilize the currency rates. So these are the main participants in the foreign exchange markets. Okay, so what are the various kinds of, I mean, not the various kinds, but what are the, currency, how does the risk arises because of the currency exposure? So we'll learn that. So first example comes to an exporter. Suppose you are an exporter, okay? An exporter who sells his product in foreign currency has the risk that if the value of that currency falls, then the revenues in exporter home currency will be lower. Okay. For example, if you are an Indian exporter, so you export money and you have to receive your dollars from America. So at the time when you exported, the dollar was at 75 rupees. But suppose when you're receiving the money, it goes down to 74. So you're going to receive 1 rupee per dollar less. So it's going to hurt you. It's going to hurt your bottom line. So if it happens that the dollar depreciates, okay, against the rupee, or the rupee appreciates, then the exporters get hurt. Okay. Now, many of the students, they ask these questions, So this is an explanation for that. Now, if you are an importer, now this is a very simple one. An importer who buys goods priced in foreign currency has a risk that the foreign currency will appreciate, thereby making the local currency cost greater than expected. Now, if you are an importer and at the time when you imported your goods, the dollar was, at 75, but when you have to make a payment at a later date, it happens that the dollar has moved to 76. So you have to pay 1 rupee per dollar more on your imports. So it is going to hurt your bottom line and it is going to adversely affect your business. So as an exporter or an importer or a service provider, or if you're investors, you can be hurt because of these movements. Okay. So the fund managers, now we come to the investment side of the business. The fund managers and companies who own foreign assets, and again, the companies, who have subsidiaries abroad, are exposed to fall in currencies where they own assets. So if you have an asset, say in America, in dollars, if the dollar depreciates, so the value of the asset will go down, or the value of the investment will go down, and vice versa for a foreigner who invests in India. So now we come to the most important one. Okay, what are the types of exposures? And you should remember them all the time to come. So there are 3 kinds of exposures today we are going to learn, and we are going to do 2 questions, okay, on that. First one is called the translation exposure. Of course, there's something to do with the balance sheet. There's an accounting exposure, which we'll learn more in detail. And the second one is an important one. It affects the foundation of a business, and it's called the operating exposure, or also called economic exposure. And this is the more, a solid kind of an exposure which a company faces. The companies can, run into losses, or they can lose their value because of this kind of an exposure. So we'll understand this more deeply later on. The last one is the transaction exposure. Okay, so this is, we'll do a question on that, so you'll be able to understand greatly. So the operating exposure is also called the economic exposure. Now, translation exposure is companies' equities and assets, liabilities, or income will change in value as a result of exchange rate changes. And we'll be doing some examples to understand more about the translation, operating, and transaction exposures in the coming slides. So let's focus now on the transaction exposure. It is a risk that the currency exchange rate will fluctuate after a firm has already undertaken an obligation. Okay, so it is a risk that the currency exchange rates will fluctuate after the firm has already undertaken a financial obligation. So, for example, if an Indian exporter has a receivable of 1 lakh US dollars during 6 months, hence, if the dollar depreciates relative to the rupee, a cash loss occurs. Okay, if the dollar depreciates, so then there will be a cash loss. Fine. Suppose you have to receive $1 lakh and the dollar comes down from say 74 to 73, so you're going to lose your money. Conversely, if the dollar appreciates relative to the rupee, the cash gain occurs. Suppose it moves from say 74 to 75, when you were, you entered into a transaction and you were to receive money from abroad, and then you received after say a couple of months, and the dollar has gone to 75 from 74, so you make money. So this is a transaction exposure. Okay, so let's do this question now. So please focus, and there will be one question which you'll be doing almost similar. So please, I'll give 5 minutes to you to solve that question after I complete this exercise. Okay, so I'll explain this. So this is a company called Messrs. Omega Electronics. They export air conditioners to Germany. So they are selling their air conditioners to Germany by importing all the components from Singapore. So the raw material, the inputs come from Singapore and the final product goes to Germany. The company is exporting 2,400 units at a price of euro 500 per unit. So that means they are selling 2,400 units at euro 500 per unit. The cost of imported components is 800 Singapore dollars per unit. Now, the fixed cost and other variable costs per unit are rupees 1,000 and rupees 1,500 respectively. The cash flow in foreign currencies are due in 6 months. That means when you export or import, you have to pay. I mean, you will receive your money, say, after 6 months, and again, you have to pay your money also for your inputs after 6 months. Now, the exchange rates are given. The current exchange rates. So the first one is the current exchange rate, okay, which is rupee versus euro, okay. So, and the second one is rupee versus dollar, Singapore dollars, which is 27.20 and 27.25. Okay, so it is 27.20, not dash. So read it as 27.25. Then after 6 months, the exchange rate turns out as follows. So this was the rate at the time when he entered into all these transactions. So after 6 months, the euro has gone up 52 and 52.05. Okay, you can see, compare the spot and the current rate. So you find that the euro has appreciated. Okay, so this is going to be a positive for your company like Omega. But the Singapore dollar has also appreciated. So that means for all your inputs, you are going to pay more now compared to the rate at which you entered the transaction. Okay. So you are required to calculate the loss or oblique gain due to the transaction exposure. So we'll understand this question now and we'll solve it. Okay. So let's just revisit this question once more. So Omega Electronic Limited exporter exports air conditioners to Germany. So what he's doing? He's exporting air conditioners to Germany by importing all components from Singapore. So his revenue comes from Germany, but his cost, inputs, raw material come from Singapore. How much he exports? 2,400 units at a price of euro 500 per unit. And the cost of imported component is how much? Singapore $800 per unit. The fixed cost and the variable cost is in rupee terms. So the fixed cost and other variable cost are 1,000 and 1,500. So the question is, Sumit Jain, is this gain loss is notional? No, it is not notional. It is actual. Okay. So please understand this question and you will follow it. And I'll explain you again once I'll just address this question. It is not notional. Our transaction exposure is not notional. It is real. So Omega Electronics is an exporter. The cash flows in foreign currencies are due in 6 months. So he's going to get his money after 6 months. And he's going to pay also after 6 months for his imports. But for all his exports, he is also going to get the money after 6 months. The spot rate is on your screens for euro, and the spot rate for Singapore dollar is also on your screen. Okay. Then the spot rate after 6 months is also on your screen, and the spot rate after 6 months. So these are the spot rates. Mind you, these are not the forward rates. These are the spot rates after 6 months. Okay. The spot rate, current spot rate, and the spot rate after 6 months is given to you. Fine. So if you can just visualize these spot rates, the euro, if you look at euro, the spot rate versus the 6 month spot rate, you'll find the euro is going up. Okay. Both the bid and ask rates are going up, from 51.50 to 52 and 51.55 to 52.05. So if the forward rate goes up, what happens? The exporter is going to make money. Okay, because he's going to get a gain. So since he has not entered into any kind of a forward transaction or a forward cover, so he'll be getting his money only after 6 months. So he's going to gain. Okay, fine. And let's look at the Singapore dollar, because his costs come from Singapore. So the rates have gone up from 27.20 to 27.270, 50 paisa. That's a big amount. And the ask rate is also gone up from 27.25 to, so I mean, both bid and ask have appreciated. So his imports have become costlier. So though he's going to make a gain while he has exported goods to Germany, but he's going to lose for the money which he is going to pay in terms of Singapore dollars. So this is a real loss. Okay, so let's understand now. So you're required to calculate the loss gain due to the transaction exposure. So this is a transaction exposure, so which means it's a real one. Okay, so let's understand. So profit at the current spot rates. So first we'll look, suppose he would have realized his money as per the spot rates at the time when he did his transactions, all these transactions. Suppose he would have got the money at that time, but he's supposed to get after 6 months. But we are trying to work out, suppose he would have received the money as per the spot rates. Then you know that the units are 2,400. The selling price is 500 euros, and we will take the bid rate, okay, which is 51.50. I'm going to explain that also. Because he's going to take a bid rate, because he's going to get dollars and he's going to go to the bank, and he's going to convert his euros into rupees. So he's going to sell his currency, and the bank is going to buy. So that's why the bid rates are applicable. So 6 crore 18 lakhs he's going to get. He would have got at that time if the rate would have been as per the spot rates. Now, the components which are, in terms of Singapore dollars, so there also the ask rate is applicable. So his cost is 800 Singapore dollars, the unit at 2,400. And if you multiply with the ask rate, that means the rate is asked. So he's going to, go to the bank and ask for Singapore dollars. He's going to buy. Okay, so he has to pay the ask price, but he's not paying because these are the spot rates. So just to explain, had he got his money at the spot rates, at the current spot rates, he would have actually incurred a 5 crore 23 lakh 20,000 rupees. Okay, so we know the fixed cost and variable cost is 1,500 and 1,000. So that's a pretty simple 2,500 multiplied by 2,400. So that comes to 60 lakh rupees in terms of Indian rupees, which is going to invest. He's going to incur in India. So total cost will be 5 crore 23 lakh 20,000 plus 60 lakhs. So that comes to 5 crore 83 lakhs. And the money he would have, the seed was 6 crore 18. So so that means he would have made a profit of 34 lakh 80,000. So if you look now, the rates are coming up, which are given in your question. So if you look sales, so the bid rate was 51.50, and we have used that. And the ask rate was 51.55. So bid is basically at which he's going to convert his euros into Indian rupees. He's going to go to the bank. Okay, so he'll look at the buying rate of the bank because he's going to sell his euros to the bank. So 51.5 will become applicable. Similarly for his imports. So he's in this he's going to use the rate at which the bank is going to sell it to him. And he is going to buy at 27.25, which is the ask rate. That is his buying rate from the bank, which is 27.25. And always remember, the bid is lower, ask is higher. So while you buy currencies, you have to pay a higher rate. While you have to sell your currency, when you receive it from abroad, you get a lower rate. So this we have explained in our basics. So he makes a profit of 34 lakh 80,000. But that was not the case. So he had to wait for 6 months to get his money. So let's see. Now the 6 months are over and he's going to get his money. Now he's going to go to the bank. So 2,400 units, selling price is 500 euros. So here the bid rate is 52 rupees. Okay. So we'll soon look at the bid rate, which will come on your screen, which is given in the question. So which is 52. So he's going to get 6 crore 24 lakhs as against 6 crore 18 lakhs. So that means he's making a gain. As I told you in the beginning, that he's going to make a gain because of the favorable appreciation which is happening in terms of euros. He's going to make money. So, but he's going to lose on his components. So, he's going to pay a higher ask price. If you remember, it was 27.25 and now it is 27.75. So he's losing. So he has to pay more money in terms of input cost, which will be 5 crore 32 lakhs 80,000. So the fixed and variable cost remains the same. So total cost will be 5 crore 92 lakhs 80,000. Okay. So one extra comma is there. So we can just, reduce it. So this is, okay. So that means his profit will be now 31 lakh 20,000. So how much profit he was making earlier? He was making a profit of 34 lakh 80,000 at the spot rates. But now he is making a profit of 31 lakh 20,000. Okay, so that means loss due to transaction exposure is 3 lakh 60,000. Now, how 60 lakhs has been calculated? That is, simply 2,400 multiplied by 2,500. So that comes to 60 lakh rupees. So the question was how 60 lakhs, Sumit Jain, 60 lakhs has been calculated by 2,400 units multiplied by his fixed and variable cost. Okay, which is 1,000 plus 500. So it is total cost is 2,500 multiplied by 2,400 will give him a total outlay of 60 lakh rupees. Now, if you look at your, on your slide, the rates of, the bid and ask rates are given for euro. The bid rate is, 52 rupees. Okay. So there's some mistake here. It is 52. Let's check what is the rate. Yeah. So bid rate is 52. Okay. So 52. So let's go back to the question. Yeah. So bid rate is 52. Okay. So I'll just make a change here. Some typo error. So, so 52 rupees is applicable for the bid rate, and the ask rate is 27.25. Okay. So, so that's it. So he's going to make because of the translation exposure. So he's made a loss of 3,60,000. Very good, Mumbai Mambika. So now, if you look at a couple of things there, because I have arrived a figure at the bottom of the screen, which is 6 lakh he's gaining on account of the sales. That means the euro has appreciated, so he's making a 6 lakh gain because of that. But he's losing heavily in terms of inputs, which is in Singapore dollars. So he's losing 9,60,000 on Singapore dollars, but gaining in euros. So overall, a net loss of 3,60,000. So I hope you have followed. So in this example, you can understand that why he makes money in his sales because the euro has appreciated. So he's making a bigger gain of around 6 lakhs, but he's losing in terms of the Singapore dollar appreciating by 50 paisa. So he's losing, and he's losing how much? 9,60,000. So which makes an overall loss of 3,60,000. Okay, so now it is your turn. So please, now the question will be there on your screen. So quite a similar question. Okay, I have not changed much. So only now it is rupee euro versus rupee dollars. Okay, so look at this question. It's quite similar in nature. I think you can solve it. So I'll give you 5 minutes for that. So exactly at 7:40, I'll come back to you to show you the answer. I'll give you 4 minutes to solve it. Since most of the numbers, like Indian numbers, are same, so you can just put 60 lakh rupees to solve your answer. So 2 more minutes left. Please hurry up and I need answers from you. I hope you can do it. So while you're doing your question, so again, basically you have to use the bid rate for your exports and ask rates for your imports. So you have to use the bid rates for your imports and ask rates for your imports. Why bid rate? Because you're going to go to the bank and you're going to convert your foreign currency into Indian rupees, and since you are exporting washing machines to USA, you will get the money in dollars. So you approach to the bank and convert your money. So you're going to sell your currency. So you look at the bid rate of the bank. Whereas if you are you're Germany, the importing all components from Germany, so you look at the ask rate, because you have to make a payment to Germany in terms of euros. So the relevant rates would be the ask rates. Why? Because you're going to purchase euros and you are going to buy them. So you are going to look at the selling rate of the bank, which is the ask rate of the bank. Okay. So now I'm just going to show the answer. I think most of you have done. So profit at the current rates are given. So the profit was 57. You can check your answers by the time. So at the current rates, you make a profit of 57,31,250. Okay, fine. So the answer is on your screen, so you can check the profit, how much he would have made had he would have got his money immediately at the current rates. So assuming current rates, he would have made a profit of 57,31,050. But if we move on and calculate his profit after 6 months, how much would he have made? So he would have made a profit of loss due to transaction. Yeah, he would have made a profit of 43 lakhs. So again, he's losing. So loss due to the transaction exposure is the profit earlier, which was 57 lakhs 31,250, and now his profit has been reduced to 43 lakh. So overall, his profit is down by 14 lakh 31,250. So I hope it matches with the answers you have done at your end. And now we will be, so this is, if you look at the explanation again, so it is basically the profit is coming from the exports, but he is heavily losing on accounts of imports, which is 25 lakh 31,250. So yeah, loss is 14 lakhs 31,000. Absolutely right, Chavi. You are bang on. And the profit he's making is on account of his export realization, which is 11 lakhs. Okay, but he's losing because the euro has appreciated and causing a loss of 25 lakhs 31,250. So overall, a loss to him in the business would be 14 lakh 31,250. So that's a real loss. Okay, so so that now we come to the translation exposure. Okay, so what is a translation exposure? The risk that the organization will make exchange losses when accounting the result of its foreign branches or subsidiaries. When the accounting results of its foreign branches or subsidiaries are translated into home currency. So can you look at the slide again? It has 3 steps. This is the risk that the organization will make exchange losses when accounting results of the foreign branches or subsidiaries are translated into home currency. Okay. Fine. So translation exposure, also called an accounting exposure. Okay, we are all accountants, so we know that it is an accounting exposure. It's a notional one. Okay, till the time actually you realize it, or I mean so till the time it is it's just a notion. So this is a notional. Okay, a typical example of translation exposure is a treatment of foreign currency loans. Okay, and let me just give you an example. Okay, for example, let's take for example, a German subsidiary of an American company purchases a building worth 1 lakh euros on 1st October 2019. Okay. Suppose a German subsidiary of an American company, mind you, it's a German subsidiary, an American company, the holding company, who purchases a building worth 1 lakh euros on 1st October 2019. Now, on that date, the euro dollar exchange rate was $1 was equal to 1.25. 1 euro was equal to $1.25. So the value of the building converted into dollar would be $1,25,000. So for the holding company, this was the cost to them in terms of dollars. Okay. Now, the company decides to convert all the foreign holdings into a dollar to present a consolidated balance sheet on 31st of December 2020. Normally it happens, the year happens in the Western world in December. So 31st December 2020, incidentally, it happens to be the day today. On that day, the exchange rate changes to 1 euro is equal to $1.20. So the value of the building falls to $1,20,000. So when they will convert, and consolidate into their accounts, so they'll find the value has actually gone down from 1,25,000 to 1,20,000. So this is a translation exposure example. Now we come to the most important one, the economic exposure, which can, hit the foundations of an organization or an entity. So this refers to the effect of movement of exchange rate on the international competitiveness of the company. Okay, competitiveness of the company. Economic exposure is the term used to define a risk posed by foreign exchange rate fluctuations with adverse effect on the company's financial stability. As I told you, that is the major kind of exposure which the company faces. Okay, the economic exposure is a term used to define the risk posed by the foreign exchange rate fluctuation with an adverse effect on the company's financial stability. So Indian company uses, let's take an example to understand that. An Indian company uses raw material which are priced in US dollars. So it's buying from US, but exports its product mainly to within European Union. Okay, so their customers lies in Europe, but they are buying the raw material from dollars. We almost did a question like that, just now. A depreciation of rupee against the dollar or an appreciation of rupee against the European Union currencies will both erode the competitiveness of the company. So let's understand how depreciation of rupee against dollar will make the raw material costlier. Okay, depreciation of rupee means appreciation of dollar. If the dollar appreciates, definitely you are going to spend more money in terms of dollars to buy your imported components. And appreciation of rupee against European Union will reduce your revenue. If the dollar falls from 74 to, if it falls from say 80 rupees per euro to say 78 rupees, so you're going to get less. So it is you're going to receive less money for your top line. Now let's understand this through this diagram. So there are two kinds of exposure which the company faces. One is the asset exposure, other is the operating exposure. Now the asset exposure is basically whatever assets you own abroad in terms of foreign currency. Okay, and the operating exposure is in terms of cash flows which you are going to generate. Either you have to pay money for your imports or you're going to receive money from outside. So these are the operating exposures. So the exchange rate fluctuation movements can affect both of them. Now, asset exposure, home currency, values of assets and loans and liabilities get affected. As we have seen through an example which we did just now. Home country's currency, value of assets and liabilities will go under change. Then future operating cash flows of the company. Company is going to, import goods from abroad or exports goods and they're going to receive money. So it is going to impact sometimes favorably, sometimes, adversely on the future operating profits of the cash flows of the company. So it affects the value of the company. If you remember in your valuation class, the value of the company is derived by by discounting all the cash flow which the company is going to make. So that's the value of the company. So you discount all the future operating cash flows at a discount rate, which is normally the cost of capital of the company. So you arrive at the value of the company. So your future cash flows are going to be affected by the adverse movements or sometimes the favorable movements. So the value of the company can go up and down based on the cash flows you're going to generate. And similarly, if you're going to value the company on the basis of the assets which you own, on the basis of the market value, then again, it is going to affect the value of the company. So the operating exposure is the deadliest of the all, and it can either ruin or make the company very profitable if you don't hedge yourselves, or you leave the exposure untouched, unhedged. So this is the kinds of exposures which we have done. So this covers basically the topic for the various kinds of exposures. So now we will be we'll be going and doing some questions on them later on. Okay, so let's go to now the hedging the currency risk. Okay. So I'll just pause for a while. Okay, so this is a new chapter which we'll be doing altogether. Okay, so I'll be just showing the slide again to you. I think this slide is going back. So yeah, it has come now. Okay, so we have now the hedging the currency risk. So there is some technical issue because the slide is, yeah, it has come back again. Yeah, it's available. So let me look if you have some queries. Yeah. So can a transaction be both economic and transaction exposure? Yeah, the example which we did, was a transaction exposure, but it can affect. It's a sub part of the economic exposure. Economic exposure is a bigger game altogether, and transaction exposure, a series of transaction exposures, lead to economic exposure. So that's a very good question. Can a transaction be both economic and transaction exposure? So yes, a series of transaction exposures can affect a company, the value of the company. Okay, so transaction exposure can be just one-off, but if you have a transaction exposure hitting you all the time, and you have series of transaction exposure which can affect the company valuation, then we call it as an economic exposure. Okay, so that's a great question. So let's now do hedging currency risk. Okay, so which is one of the best topic under this subject, and most of the questions will be coming from this topic. So I will tell you to pay utmost attention, and we'll be doing all the important questions which have been there in your practice manual or study material, and this will be quite interesting for all of you. So hedging currency risk is a way of a company to minimize or eliminate the currency risk. Okay, fine. So there are a couple of techniques through which you can eliminate. There are two kinds. Broadly, we can classify these techniques into two: internal techniques within the business itself, external techniques involving dealing with the third party. So there are two kinds of techniques through which you can manage your foreign exchange risk. First being internally by the business itself without taking any support from outside. The second is external techniques involving a third party, involving a bank or involving a stock exchange or any other party through which you can try to hedge your transaction. So let's understand these two techniques. They're very interesting, and most of your questions will be from this topic. So the first one is leading and lagging. Leading means advancing a payment. that is making the payment before it is due. Lagging involves postponing a payment, that is delaying the payment beyond its due date. So you can always, if the situation allows, if you have this advantage, you can manage your foreign currency risk. So let's understand. For example, X Limited imports $1 lakh goods from abroad. Now the current rate is rupees 75 per dollar. Now the money is payable after 6 months. But if you expect, if this company X Limited expects dollar to appreciate significantly in the next 6 months because of the analysis, because of the forecasting techniques, if they have they find that the dollar is going to appreciate significantly because of some international events which are going to happen, and so X plans to pay the amount upfront. So what we'll do, X will say, okay, I'm ready to pay it now instead of paying after 6 months. Why? I'll lose. So he's going to take the cost benefit analysis in terms of how much money he's going to lose on account of interest if he pays now, and how much the dollar is going to appreciate. Okay, so the dollar is appreciating, say, the money is falling due after 1 year, and the dollar is going to appreciate, say, by 8%. Okay, and he's paying only 5% interest rate. So it makes sense to pay the money upfront. Right. So the second is invoicing in domestic currency. Now, by doing so, you're totally out of this foreign currency risk business. Invoicing in domestic currency, but hardly it is allowed by your customers. But if it happens, your customer is willing to go for it, so you can do that. So an exporter can shift the transaction risk to his customer abroad. So basically, the risk which you are taking on your shoulders, you are actually not transferring it to shoulders of your customer. So how it can be done? Let's take an example. Suppose X Limited invoices rupees 75,000 for the exports. So he's going to invoice at rupee value 75,000. So he's going to get 75,000 after 6 months. So at the time of export, the dollar was rupees 75. The payment is going to be received after 6 months. Now he is going to receive 75,000 rupee from your importer. Okay, whatever be the dollar rate. Suppose the dollar touches to 70. Now he's an exporter, he would have lost. Suppose his exposure was in dollars, he would have received 5 rupees less after 6 months per dollar. But now he's going to receive 75,000. So that means the exporter goes and now pays. He has to spend, instead of $1,000, he's going to spend $1,071.42. Okay, so the exposure has shifted to the exporter. Okay, so how is it worked out? 75,000 rupees divided by 70 rupees, which is the current rate of rupee per dollar. So he is going to shell out now $1,071.42 to make the payment to you. So in this case, you have gained, not gained, but you have remained the same, but your importer, your customer has lost. Okay, because he is going to spend more money. But I mean, maybe most of the time it will not be the case here. I mean, customer would be willing to take the risk on his shoulder. But if it is the case, and you have a great negotiating capability, then if you think the dollar is going to appreciate, that's normal case. It happens most of the time. So you can go for this. Now netting. Okay, I'll see if there are any questions. So Anand Nandekar, hi sir, I'm a member of the institute and sometimes listen to the online classes to freshen up basics. I find your method of teaching very easy to understand and close to practice. So being a corporate banker, I can vouch for that. Regards, Anand Nandekar. Thank you very much, sir. Thank you for saying that, and it really gives me a great heart. And once again, I thank Mr. Anand. So please do listen. I always use a very simple language because I know if I don't use a simple language, how can the students follow it? And though this topic is, as you know, is very, very tricky one, very complicated one. And since I've worked in corporate world, so this is the way of teaching really helps. If I can understand in easy language, I can explain that to others also. So that is my way. Okay, thanks a lot. So now come to the netting. So netting exposure, exposure netting is a method of hedging currency risk by offsetting exposures in one currency with exposure in the same or another currency. So you're doing netting. So you're netting. So once again, I read, exposure netting is a method of hedging currency risk by offsetting the exposure in one currency with exposure in the same or another. So either it can be the same currency or another currency. So I'll give examples for both. So let's take an example of netting. X Limited owes $1 lakh to its group company X USA Limited for the goods supplied, and X USA Limited also owes $80,000 for the services provided to X India Limited. So you have 1 lakh to receive and 80,000 to pay. It can be netted off, okay, but not fully, but at least the exposure will go down. So now let's take the same example, same thing in netting when the currencies changes. X India Limited owes 1 lakh US dollars to its group company X UK Limited for the goods supplied, and X UK Limited also owes 78,000 pounds for the services provided to X India Limited. So these are, mitigating, payments and receivables. And suppose it happens that $1 is equal to 0.78 pounds, then it will get fully netted off. But this is dollar versus pounds. The first example was dollar versus dollar. So this is, if you read the line, exposure netting is a method of hedging currency risk by offsetting exposure in one currency with exposure in the same or another currency. So this is an example of another currency. So you have payables in dollars and you have receivables in pounds, and you can always net it off. Okay. So now we come to the matching concept. So matching extends this concept to include the third parties, such as external suppliers and customers. So matching and netting and almost sounds the same, but in case of netting, the terminology is used for your in-house, your subsidiary and holding companies, receivables, and all those kinds of matching can be done. But matching here applies to the third parties as well. Now we come to the price variation, which involves increasing selling prices to counter the adverse effects of exchange rate change. Now, which means that if you expect the currency to appreciate, you can price it more. Of course, in the business situation, that may not happen. That may not be allowed because of the competition. But if it is there, then you can always do that. If the situation allows you to do that, then you are actually hedging yourself by increasing the price. So let's take an example in this. So if a company expects, now we talk about say Indian company, the Indian company expects the pound to strengthen against the currency of an overseas customer, it may raise the contract price. So because at the end you have to pay more in terms of pounds, in terms of in the home currency, so you are going to increase the price so that you spend the same amount of money. So now we come to the last one, the asset and liability management. Now, this is a very important one. So asset and liability management, ensuring that the assets are available to appropriately cover the liabilities when they are due or expected to be due. Okay, so this is an asset and liability management. Most of the bankers do that, okay, because they have, they're earning interest and they're paying interest, so they have to match those things. And but let's talk about in respect to the foreign currency, asset and liability management, ensuring that the assets are available to appropriately cover the liabilities when they're due or expected to be due. So let's, take an example. Suppose a company has a deposit of 1 lakh. So there's a company which has a deposit of $1 lakh and a payable of $1 lakh after 6 months. And the deposit is also say there for 6 months. So you have an asset and liability of $1 lakh each. Now the spot rate is 75. After 6 months, even if the spot rate on that day goes up to 76.50, so your asset and liability is well managed. So this is a very simple example to cover that. Let's go to another example. Suppose a company has a receivable of $80,000 after 6 months, and also an investment of 20,000 maturing next 6 months. Now there is a payable of $1 lakh after 6 months. So this is the provision. The company has receivables of 80,000. So they have investments which is going to mature after 6 months, and they also have a payable of 1 lakh after 6 months. So if the spot rate is 75 today and it goes to 76.50 after 6 months, then you are not bothered because the assets and liabilities are well managed. Okay. Now this concept of asset and liability management focuses on the timings of cash flows, because the company managers must plan for the payment of liabilities. So most of the time, banks are in this, they have to do it, and big corporates, they have to do it. Okay. So the process must ensure that assets are available to pay debts as they come due, and that assets or earnings can be converted into cash. So let's understand, there's an example here. Assume, for example, that the bank earns an average rate of 8% on 3-year loans, which it has given to its customer, and pays 6% rate on a 3-year certificate of deposits. So that means the money they have got it at 6% and they have lent it at 8%. So their interest rate margin, that is the NIM, which is called the net interest margin, the bank generates about 2%. Okay. So they would like this margin to be maintained even if the interest rate goes up and down. Since the banks are subject to interest rate risk, or the risk that the interest rates increase, so clients demand higher interest rates on their deposits to keep the assets at the bank. So they would like to jack up the interest rates on the loan which they have given. Okay, so they would either go for more low cost deposits, which are by having more of current accounts and saving accounts, which are called the CASA accounts. So they can always manage their asset and liability risk by doing so. Okay. So now we'll be doing, so in Jen, both the parties should be same in internal techniques. It can be a subsidiary and holding company for, internal techniques can be even outside parties, as I said, matching, for example. Okay. Fine. For pricing and all those, they were different parties. And I don't know how you got an impression that both the parties should be the same. Okay. So if we just, revisit that again for your benefit, because you said both parties should be same. So let's go back and see each case by case. So internal techniques within the business itself. Now it can be done, within the business. Doesn't mean that the parties have to be same. Okay, fine. So leading lagging, you can make a payment later. So your payment is due to someone, okay, which is a third party, and you're taking kind of this thing that you are making the payment upfront. So the other guy will be very much happy to receive his payment early. So it is not the same party. Fine. And then invoicing in domestic currency, again you can do it for someone, your customer, if he allows you. So it can be a third party. Okay. Netting. So netting, as it is applicable mostly to your own group companies. Okay. But matching is when you talk about the companies from the third parties, price variation. Again, it involves not the same company but the other parties. Okay. So I think that covers everything. So let's do some questions now, which were there in your. So we'll do one question, okay? And then we'll have a break. Okay. So I think we have done a pretty stuff up to now. So it will require a small break so that we can gather ourselves again. So one small question. Okay, so this is a small question. So I think it will be. Following are the details of cash flows and outflows in foreign currency. Denominations of NNP Co., an Indian exporter firm, which have no foreign subsidiaries. Okay, so this is a details of cash flows and outflows in a foreign currency denominations of a company which is called MNP. So I think there is fine. So if you see on your screen, there are their exposures of this company in dollars, French francs, pounds, Japanese yen, and then how much money is going to receive. There are inflows, and they are at the same time the outflows are also given, and the spot rate of the currency is given, and the forward rate is also given. Okay, so US dollar, he has exposure of 4 crore US dollars, and outflow is about 2 crore outflows. So the net would be around 2 crores, that means. Okay, and the French franc is basically inflows are 2 crores and outflow is 80 lakhs. So again, he has exposure of the difference of that. Since the spot rates and forward rates are higher in terms of US dollar and French franc, so fine. So UK pound, it is 3 crores and outflow is 2 crores. Okay. So in Japanese yen, of course, he has the reverse. His inflows are expected to be 1 crore 50 lakhs. His outflows are 2 crore 50 lakhs. And the spot rate is 3.20 yen per rupee per yen. And the forward rate is 2.40 paisa, 40 rupees per yen. Okay. So these rates are given to you. Determine the net exposure of each foreign currency in terms of rupees. Okay, that's the first question. Second is, are any of the exposure positions offsetting to some extent? So, so these are the two questions which have been asked under this, all the data which has been provided to you. So what we'll do, we will calculate the net exposure of each foreign currency in rupees. So, I'm just converting them to short numbers. So, in US dollar, it is 40 million US dollar is his inflows, and outflow is 20 million. So that means the net inflow would be 20 million in terms of US dollars. And the rate is, the spot rate is 48.01, and the forward rate is 48.82. So that is $1 is equal to 48. This is a pretty old, quotation. I've taken it from your study material. So, which means the spread is 0.81. So the net exposure will go down to 16.20 million. Because his inflow happens to be 40 and outflow 20. So the net inflow, that is the net exposure, is 20 million. And since the dollar is appreciating from 48 to 48.82, so his exposure will further go down to 16.20 million. And let's look at the French francs. It is the net exposure is 12 million. And again, here also the French franc is actually moving up from 7.45 to 8.12, the forward rate. So that means his exposure will further go down, and it will be 12 multiplied by 0.67, which will be 8.04. Now 16.2 has how it has been calculated, 20 multiplied by 0.81, so 16.20. So in pounds, his exposure is will further go down because pound is also appreciating from 75.98 to 75.57. So he has a net inflow of 10 million. So that means this exposure will further also go down to 4.1 million. And then we look at the Japanese. So here he has a negative inflow. Okay, so that means his outflow is more on account of inflow, but since the dollar, the rupee is appreciating or the yen is depreciating, so again this exposure will also go down. Okay, fine. So to 8 million. So the exposure of Japanese yen position is being offset by a better forward rate because he is going to make a payment in 1 year's time. So at the time when you entered his contract, it was 3.2 at the time, but now it is 2.4. So he has to pay much less. Okay, so it is going to be a better forward rate will actually offset his position. So now we will go to another question after some time. So after the break, okay. So we have a break now for 10 minutes, okay, and Okay, so we should start now. So we resume our now after the break. So what we are doing now is we are doing yet another exercise. Okay, so this is a question now. I hope you have got your slides with you, all of you. So this is an exercise. Following information relates to a company called AKC Limited, which manufactures some parts of an electronics device which are exported to USA. USA, Japan, and Europe in 90 days credit term. So that means this company's name is AKC, which manufactures some parts of an electronics device which are exported to USA, Japan, Europe on 90 days credit terms. So this information is all given to you. Cost of sales, cost and sales information is given to you. Variable cost in Japan, USA, and Europe. So variable cost per unit is rupees 25 rupees, 225 rupees, and USA it is 395 rupees, and Europe it is 510 rupees. So export sale price per unit is also given in terms of Japanese yen, 650. USA it is $10.23 per unit, and Europe it is 11.99 euros per unit. And they are going to receive the money in 90 days, and the total money which they are going to receive from Japan is going to be 78 lakh yens. And from in dollar terms, they are going to receive from USA is $1,02,300, and euros going to be 95,920. Now, following are the exchange rate information. So the spot rate is given, and 3-month forward rate and 3-month spot rate. So mind you, 3 rates are given: spot rate, that is today's rate, 3 months forward rate is given, and 3-month rate which is going to be there. I mean, after the 3 months are over. So what is the spot rate at that time? Now the quotes are basically, if you see, these are all indirect quotes as per the Indians are concerned, because it says 1 rupee is equal to so many dollars, or 1 rupee is equal to so many yens, and 1 rupee is equal to so many euros. So these are all indirect quotes. Okay, fine. So we will see how we can solve our question by using these indirect quotes. Now, advise AKC Limited by calculating the average contribution to sales ratio, whether it should hedge its foreign currency risk or not. Okay, so basically question says, we have to calculate the average contribution to sales ratio. Okay, and see, which one is better. Should we hedge or should we leave it unexposed? Okay, should we carry the risk and wait for the 3 months to happen and receive money at that time as per the spot rates? So let's understand. Now, let's look at the hedging option first. Now we know that the sales numbers are given to us in terms of the Japanese yen, which is 78 lakhs yen the company is going to receive after 6 months. Okay. And let's see, it's after 6 months. Yeah, 90 days credit, sorry. So they are going to receive after 90 days. And US dollar is 1,02,300 US dollars they are going to receive after 90 days. And euro is going to be 95,920 euros. They are going to receive after 90 days. And we know that unit price is given to us, which is 650 yen. So we can just simply, divide 78 lakhs by 650 to calculate the units. Now, why we do it? Because we are going to calculate the contribution margin. Okay, and see, what happens using a hedging option as well as using leaving the exposure uncovered. So now we have arrived at units 12,000, 10,000 units, and 8,000 by simply dividing the sales divided by the unit price. Now the variable cost, which has been given to you already in the question, which is 225 rupees for yen. So we can just multiply the variable cost into the units sold and arrive at the variable cost. Okay, so it is 27 lakhs in case of the Japanese yen currency, and which is exporting to Japan. And then the variable cost is 395 rupees per unit into 10,000 units, so it comes to 39 lakhs 50,000. Okay, and for euros, if you calculate, the total number of units are 8,000 units, and variable cost is 510. Now the variable cost is given to you in the question. Okay, so So we calculate the variable cost. So overall, if we add all these three figures, we'll get a total variable cost of 1 crore 7,30,000. Okay. Now, 3-month forward rate. So forward rate, what we are using is a forward rate, what we are using for taking a forward cover. Okay. So the rates are given to you. So we'll take the selling rate. So which is 1 rupee is equal to 2.427. I'll show you the full quotation very shortly. And 1 rupee is equal to $0.216. So these are indirect quotes which are given to you. Okay, 1 rupee is equal to so many euros. So now we calculate the value of the receipts. And how do we do that? Basically, and we'll just, I'll show you how the calculations have been done. But of course, this is your total yen, which is given, and the currency rate is given. By using that, we have calculated the value in receipts. So it comes to 32,13,000. Okay, I'll just show you that. Okay, very shortly. So now, if you look at the rate here, 78 lakhs is the yen. So we divide it by, because this is an indirect quote, so we will divide by 2.427. Okay, so we'll get the number 32,13,000. So this is the value in receipts in rupees. Okay, fine. I'll show you the detailed calculations also. So for dollars, it will be 1,02,300 divided by this 0.0216. It's happened to be not a direct quote. This is 1 rupee is equal to so many dollars, but we have to calculate how many dollars is equal to rupees. So we will, instead of multiplying, we'll divide that. Okay, and we'll do the reciprocal of the quotes. If you remember, we did it in the first basic class. So it comes to 47,36,000. And then finally for euros, it will be your 53,88,000. So which is 95,000 divided by 0.0178. So then we have the receipts in rupees. We have the total receipts now, 1,33,38,000. Okay. So we can just, do the calculation, contribution exercise. So 1,33 minus 107.30, we get a total contribution of 26,08,790. Okay, fine. So if we divide it by sales, which is 1,33 lakhs, which is there here, so we get contribution ratio of 19.56%. Okay, so what we have done, we have calculated first the contribution of each one of this thing for the yen, dollars, and euro, all is exports. So we just simply added them up. So we got the contribution for the entire this thing. So then we divided this by the total sales value to arrive at the average contribution sales ratio. Okay, so which comes to 19.56. Now, just to show you that how we have calculated. So working for 3 months forward rates. Now if the rate is given to you, 1 rupee is equal to yen 2.397 and 2.427. So this is the bid rate and this is the ask rate. So we converted our rates into yen. So 1 yen would be just the reciprocal of 1 divided by 2.427 and 1 divided by 2.397. So we'll have 1 yen is equal to now rupee 0.4120 and 0.41. So now we know that we have 78 lakhs yens to receive. So we will multiply this with the bid rate, because we are an exporter. So we'll be going to the bank and selling our yen to them. So the bankers buying rate and our selling rate is 0.4120. So we'll look at the bid rate and then multiply with that. So we get 32,13,000. So this is how I've arrived at the conversion of yen into rupees. Okay, after 3 months. So if we go for a forward option and take a forward rate contract with the bank, we are going to get 32,13,000 at the end of say 3 months, 90 days. So and similarly, for the dollars. So $1 rupee is equal to so many dollars. Okay, so we'll convert back in terms of dollars. So which is our rupee dollar code. Okay, the way we look at in India, which is a direct code. So $1 is equal to 46.29 and 46.94. So this is a pretty old code. Okay, which was there in the study material. So now here we will look at the bid rate. Okay, so that means this dollars which he is going to receive, which is 1,02,300. He is going to convert them into at the rate of 46.2936, which is, since he entered into a forward contract, So he's going to receive, after 3 months, 47,36,111 rupees. Okay. So this is how we have, first converted the indirect quote into direct quote. Okay. And then use the bid rate to arrive at his rupee receipts. Okay. Similarly, we went for the 3 months euro rate also. So here, what we did was 1 rupee is equal to so many euros. So which is the indirect quote of, so we'll convert into a direct quote in terms of rupees. So 1 euro is equal to so many rupees. So which is going to be 55.55. Okay. By simply first taking the 1 divided by 0.0180, taking the ask rate to the bid side and the bid to the ask side. So we convert the indirect quote into the direct quote first, and then apply the bid rate, which is 55.5, to arrive at the total value in terms of euros. Okay, so we'll go back to the question again. So this was, how we have so far solved the question, and we arrived at a contribution ratio of 19.56. So if he goes for a forward cover, his contribution to sales ratio is 19.56. So let's see, if he does that. So if it is not, the risk is not hedged, what happens? If the risk is not hedged, then the value, rupee value of the receipt will be 31,72,000. Okay. So that means, he's going to get his money at the forward rate, 3 months, 3 months spot rate. Okay. So 3 months spot rate will be applicable to him now then. So it is not hedged, he's going to receive the money at the spot rates prevailing after 3 months. Okay. So he's going to get these values. Okay. I'll show you how this can be calculated later on. So that means the total receipt will be 1 crore 32 lakhs. And the cost remains the same. So his contribution to sales ratio falls to 19.17. So that means where he was making more money, by taking a forward cover or by not taking a forward cover. So by leaving the exposure uncovered, his overall contribution has fallen down from 19.56 to 19.17. So that means he should go for a forward cover. Okay. So this is how we have calculated his the values at the forward as the spot rate prevailing after 3 months. So I'll show you the detailed calculation now, how it has been done. So so using the 3 months spot rate. Okay. So using the 3 months spot rate. So look at here, the spot rate is given to you in the question, which is 1 rupee is equal to so many yens. So now this is basically indirect quote. So that means the quote after 3 months, the spot rate, so which is indirect. So we'll convert into in terms of yens, in terms of rupees rather. So 1 yen will be equal to so many rupees. So so we will do is that 1 divided by 2.459 will come to the bid side, and 1 divided by 2.423 will come on the ask side. And this I have explained in great detail in my first lecture. Okay, the rules. So then 1 yen will be equal to rupee 0.40 and rupee 0.41. Okay. So then we'll be using actually the bid rate. Okay. So 78 lakh yen multiplied by the bid rate, because bid rate is what? Basically, the rate at which the yens are going to be sold back to the bank. So bank is going to buy it from you. Okay. So that means the bank is going to give you 31,72,026 rupees if you would have not taken a forward cover. And you would have waited for 3 months to happen and converted your yen into rupees. So then the money would have gone down to 31,72,026. So now let's go for a 3 month spot rate in terms of dollars. So we know that the rates are given here, which is, the 1 rupee is equal to so many dollars. Okay. So this is again an indirect quote. So we will, convert that into in terms of, the Indian direct quote, which is $1 is equal to how many rupees. So with the same process, and then we find that $1 is equal to 46.3822, which is the bid rate. So we have not calculated the ask rate here because the bid rate is more relevant. So we just simply take 1,02,300 and multiply it by the bid rate. Okay, because this rate will be given by the bank to you for surrendering your dollars and converting them into rupee. So if you're not taken a forward cover, you waited for 3 months to happen. You went to the bank. Bank says the rate is 46.3822. So you give us the dollars to us at 1 lakh at this price. So he, delivered $1,02,300 to the bank, and the bank gave him 47,44,897 rupees. Okay. So now all these numbers have been put here. Okay. So if you look at it, so these numbers are here. Fine. So, which means that he is going to now receive 1 crore 32 lakhs. So earlier it was 1 crore 33 lakhs. Now it is 1 crore 32 lakhs. Okay. So now even, without even looking at the, contribution to sales ratio, we can say that it is always better to take a forward cover, because he is getting 1 crore 33 lakhs, 38,719 instead of 1 crore 32 lakhs. So, the whole exercise of calculating the average contribution to sales ratio would have not been required to really find out, what should we be doing. So because, he's gaining more in terms of his rupee value of receipts. As per forward rate is coming to 1 crore 33 lakh 38,000, but as per the rate prevailing after 3 months, the spot rates, he would have converted and got only 1 crore 32 lakhs. So if you see on account of everything, whether it is, in totality, he receives, he is giving less. Okay, 1 crore 32 lakhs. Fine. So you should have taken, but you can even individually see also. Okay, like 32 lakhs, 13,000 is the receipt here. So it is 31. So definitely forward cover is a better option. 47.36, 47.44. So here he is receiving more if he would have not covered himself in terms of dollars. But here 53.88, 53.58. So again, this gives him a better handle on the forward cover. So he, in these two cases, he should have taken a forward cover. But in this case, he actually made more money if he would have left his exposure uncovered. But here the question says that you have to comment on the basis of the average contribution ratio. So as per the question, you have to answer. You say that the first option is better to hedge himself because he's gaining a 19.56% contribution to sales ratio as compared to 19.17. Okay, I hope this solves. Okay, I hope that you have understood this question. Okay. Okay, so let's move on to external techniques. So now we are moving on to we have done the internal techniques and did some questions on them. So and some question even on the external. Last question was not internal, but let's understand what are external techniques now. Money market hedging. So this is one. Money market hedging. Okay. And the second one is called the derivative instruments. Now these are very, very interesting, and most of your exam questions or in your practical life you will be dealing with them. Okay. So both from your from your career perspective as well as from the exam perspective, these are great learnings. Okay. So you should pay a great focus in understanding. Fine. So let's do, what is a money market hedging? Okay. So money market hedge is a technique. So it is an external technique. Okay. Used to lock in the value of the foreign currency transaction in company's domestic currency. Basically, you're trying to lock in the value of the foreign currency transaction in company's domestic currency. So you want to lock the foreign exchange rate for yourself so that you're not exposed to it. Okay. Therefore, a money market hedge can help a domestic company to reduce the exchange rate or currency risk. So basically, it's again helping you out to hedging yourself. Allowing you not to expose to the foreign currency fluctuations when conducting a business transaction with a foreign company. So basically, it's an external technique which helps you to basically manage your foreign currency risk. For example, suppose a business owner in India expects to receive $1 million in 6 months. Okay, suppose you are a business owner and you expect to receive $1 million in 6 months. The owner would create an agreement now today to exchange $1 million for INR at a roughly the current exchange rate. Okay, so this way he is going to hedge himself. Thus, if the US dollar dropped in value by the time the business owner got the payment, he would still be able to exchange the payment for the original quantity of US dollars specified. So we basically, he is hedging himself totally by, entering into and using these techniques. And we'll be understanding this through an example. Okay, so it can better explain. Now, there can be, two kinds of scenarios. One can be either you're an exporter or you're going to receive money for the services provided abroad. Okay, or you can be an importer, or you have actually going to make a payment to someone for the services you are going to receive from abroad. Okay, in any case, you are either making a payment in terms of foreign currency, or you're going to receive money from abroad in terms of foreign currency. So these are the two kinds of kind of possible situations which are going to be there. So let's talk about rupee dollar case. There are certain steps which you have to do while you adopt this technique. Okay, so to illustrate, we are just taking a rupee dollar case. Okay, for an export. So what you are going to do, you are going to borrow dollars in foreign currency. So you are going to borrow dollars. That means you are going to borrow in foreign currency. Suppose had it not been dollars, you're going to be any other currency like pounds, yen, or euros. You are going to first borrow in the foreign currency. But in this case, we are just sticking to, for our better understanding, rupee dollar case. You borrow in dollars. Okay. Then you convert those dollars into rupees at the spot rate. So first you borrow your dollars, okay? Then you convert dollars into this rupee at the spot rates, invest in rupees so that the amount grows, okay? Then the last step would be the money which you borrowed in foreign currency, you pay the loan with interest using your receivables, because you have some money to receive from your exporter, okay? So you have borrowed in foreign currency. Okay, so the borrowing should be such that along with the interest, it should be equivalent to your receivables. So at the time when you receive money from the customer, it will actually set off your loan. Okay, and you look that thereby you have made a kind of a gain, or you are hedge yourself. Okay, a foreign currency, if you have a foreign currency exposure. So all this process is going to cover yourself against the risk. Okay, and we'll understand through the example. So these are the steps. Remember these steps, and we'll be using these steps quite often in solving most of the questions, hedging questions. So, and suppose it happens to be in imports. Suppose it's a rupee dollar case again to explain. Borrow in rupees. Now it's going to be reverse. Instead of borrowing in foreign currency, you borrow in rupees, which is the home currency, and convert a rupee into dollars at the spot rates. So what you're going to do is that then you're going to convert the rupee into dollars. That means you're taking money abroad. Okay. First you borrow in India in rupees, convert that rupees in dollars at the spot rates, and invest in dollars so that the amount grows off to pay your US liability. Okay. So this is, at the end, you're going to pay off your liability from the money which you have borrowed, and whatever is your outgo on account of, the borrowed money in India is actually your total outflow on account of imports. Fine. So which I think I have not mentioned, but the last box should have been whatever money you borrowed in the home currency, and along with the interest you have to pay, if you just total it up, so that will be your outflow on account of imports. By doing so, you are hedging yourself. Okay. Now, these are the steps which we have understood. Now, we see examples to understand them and understand in reality how it works. So we'll do some practice questions to do that. Okay. Okay. So, so we are doing exercise number 4. I believe all these questions are with you because the slides have been relayed to you via the Institute of Chartered Accountants. So let's understand them. So an Indian exporting firm, Rohit and Brothers, would be covering itself against the likely depreciation of pound sterling. Now you are an Indian exporting firm, okay? So you would be covering against yourself against the likely depreciation of pound sterling. So if you lose, if there is a depreciation of pound sterling, okay, or appreciation of Indian rupee, you're going to lose as an exporter. Okay, so you are going to hedge yourself against such kind of risk. Following data is given to you. Now, receivable of Rohit Brothers. How much money is going to receive? 5 lakh pounds. Okay, the spot rate today is 56 rupee per pound. Okay, now it is close to about 100. Okay, so this is an old quotation coming out of your study material. So the spot rate is 56 per pound. The payment date is 3 months from now. Okay, so you're going to actually receive this money after 3 months. The spot rate is 56. The 3-month interest rate in India is 12%, and UK it is 5% per annum. What should the exporter do? Now, there are no forward rates. Okay, so he can't go and take him forward cover since it is not there, so we can't use it. So with whatever information is given, and since we are learning the topic hedging techniques, so we'll use that. Okay. So let's understand that how it happens. So Rohit and brothers will cover the risk in the money market. So what it'll do, they'll go and cover the risk in the money market. The following steps are required to be taken. Borrow pound sterling for 3 months. So this is an exports case. So remember, you are going to borrow in the foreign currency. Okay, that is in pound sterling for 3 months. The borrowing must be such that at the end of 3 months, the amount becomes 5 lakh pounds, because you're going to receive 5 lakhs. Okay, so the borrowing should be such that it becomes 5 lakh pounds after 3 months, so that what money you're going to receive from your exporter will be able to settle this loan of yours. So 5 lakh divided by 1.05. So we know that the rate of interest is 5% per annum, and divided by 4, because it is he's going to receive the money, say, after 3 months. Okay, so that means he has to borrow 4,93,827 pounds. Okay, if he borrows this much of pounds, okay, along with the interest he has to pay in 3 months, it will reach to 5 lakh pounds. Okay, now you remember that he has to receive 5 lakh pounds from his customer. So when he receives the money of the 5 lakhs from the customer, so this will be, he will be able to settle his loan at that time. So he borrows, 4,93,827 pounds. So what he'll do now, he's going to bring that pounds into India and convert that at the spot rate, which is prevailing at that time. The rate is given as 56 rupees per pound. Okay, remember that this is out of your question. 56 rupees is the current spot rate. So he is going to convert all these pounds into rupees. So this will come to 2,76,54,312 rupees. Okay, so now he is going to invest this money for 12%, at 12% for 3 months. Okay, so which is 2,76,54,312, which will be 1 plus 0.12, that is a 12% rate, and it is 3 months divided by 12. So that means after 3 months, he is going to get, his money is going to grow to 2,84,83,941 rupees. So this is the money which is going to generate from his investments. So now what happens is that the money, the sum of 5 lakh pounds received from the client at the end of 3 months is used to refund the loan taken earlier. So he'll settle that loan from the money he's going to receive from the customer. Now, if you see from the calculations, the money market operation has resulted into a net gain of rupees 4,83,941. How? Now he's getting 2,84,83,941 after 3 months, the money which is grown in India by putting the money in investment. Suppose he would have converted his, 5 lakh converted to the spot rate at the time, 3 months before, would have given him 5 lakh multiplied by 50. So if you just 56, so you say that, you find that it has resulted into a gain of 4,83,941. Okay, so which means the pound has appreciated in the meantime, in one way of looking at it, and you have gained a money of 4,83,941. Okay, fine. So by doing so, you are making a gain, okay, to the extent of 4,83,000 by doing this money market hedging. Okay, so this is the case of the exports. Now let's do a case of imports now. Okay, so this is another question now coming to you. Fine. Okay, so this is exercise number 5. A Limited of UK has imported some chemicals worth US dollars to $3,64,897 from one of the US suppliers. The amount is payable in 6 months' time, and the relevant spot and forward rates are as follows. So in the question, there's a company called A Limited who is in UK, has imported some chemicals from where? From USA, which is worth $3,64,897 US dollars. Okay, the amount is payable in how many days? 6 months' time. The relevant spot and forward rates are given to you. The spot rate is US dollar 1.5617 is the bid rate. 1.5673 is the ask rate. The 6 month forward rate is also given to you, which is 1.5455 US dollars bid rate and 1.5609 ask rate. The borrowing rate in UK and US are 7% and 6% respectively. And the deposit rates are 5.5% and 4.5% respectively. So the borrowing rate as well as the deposit rates in both UK and US are given. Okay. The company has two choices: a forward cover or take a money market cover. So we need to advise the company which is preferable for the company. So which of the alternatives is preferable by the company? So the question says that you have two options. Either you go to the bank and take a forward contract and cover yourself, or forget that and go for a money market cover, a money market hedging technique. Use that and see what happens. So analyze both of them and say which is better for your company called A Limited of UK. So let's revisit this question one by one, all the facts. A Limited of UK has imported some chemicals. How much? $3,64,000. Okay, from US. The amount is payable in 6 months. The relevant spot and forward rates are given to you. Spot rate is this. Forward rate is this. The borrowing rate and deposit rates are given in both US and UK. Okay, so the company has two choices. First, take a forward cover. Second, go for a money market cover. Then you find out which one is better and advise the company. Okay, so let's look at the forward cover first. Okay, so the amount payable we know is after 6 months is 3,64,897. So this is the amount which is payable after 6 months. Okay, so 6 month forward rate we know, which is given in the question, which is £1 is equal to $1.5455-1.5609. So this is the quote which has been given. Okay, so you have dollars, you have the quote in pounds. Can you do it? Not so easily. So what you do is you convert the quote into dollars. Then the simple multiplication games come into play. So you convert the pound into dollar quote by doing the reciprocal of the bid will go to the ask side and ask will go to the bid side, and you will find the dollar quote available to you. So that will be 1 divided by 1.5609, which will take place of the bid rate, and 1 divided by 1.5455 will become your ask rate. Now, since you have dollars, your money is payable to you. You have to pay the money to someone. So which rate is applicable? Bid or ask? Since you are going to go for the ask rate here, because you're going to go to the bank and say, I want dollars. So bank is going to tell you, here's the rate, 0.64704 per dollar. This is the pounds you're going to get. So this is my ask rate. This is my selling rate. Okay, so you're going to buy it. So you apply the ask rate and you get 3,64,656 into 0.64704. So this is the money in terms of pounds which will flow out of your pocket. So if you take a forward cover, how much money you're going to spend? 2,36,102. Okay. So this is the first scenario. So now let us see in money market hedging, how much is the total flow? If that is less, then we'll go for the money market hedging. If that is higher, then we go for the forward cover. So first part of our question is solved. So second part, which is the money market hedge. Borrow in pounds. Remember, this is because this is an import case condition. So you have to borrow in home currency, in pounds. And A Limited is of UK, so he's going to borrow in pounds. Convert the pounds into dollars at the spot rates. So you borrow in your home currency, take the money outside, because ultimately you're going to make the payment. So money has to flow out of the country. So convert the pounds into dollars at the spot rates. Invest the dollars so that the amount grows out to pay the US liability. Remember always, in this case, you are borrowing pounds, converting the pounds into dollars and taking the money outside and ultimately paying the money in US. In imports, it's just a reversal. You bring the money in India, or sorry, if you're talking about the dollar rupee, then you bring the money into India and then you're going to get your money in India itself. Okay, so that is what you do. So here the money is flowing out of the UK and converting into dollars. Okay, so imports, as the name suggests, the things goes out, and exports, it comes in. So invest dollars so that the amount grows off to pay the US liability. Fine. So I'll repeat: borrow in pounds, convert the pounds into dollars spot rates, invest in dollars so that the amount grows to pay off the US liability. So ultimately you have to pay a US liability. Okay. So it'll help, this money will help you to pay off the liability. So let's understand, how much should he deposit in dollars so that he can make the import payment? So first question is, how much money you should deposit in dollars? We are just taking a reverse here, because ultimately, he's going to borrow in pounds, convert that in dollars and invest in dollars, and then the money grows so that he can pay his import liability. So how much should he deposit in dollars so that he can make the import payment? Remember, we start here from the reverse always to make the matter simple. Amount payable after 6 months is 3,64,897. So this is the money which is payable after 6 months. So we know the deposit rate in US is 4.5%. So which means the present value of this 3,64,000 would be $3,64,897 divided by 1.0225, which is 4.5%. But for 6 months, it will be half of it. So we discount this by 1.0225, and that means he should deposit now 3,56,867 rupees, which will grow at 4.5%. In 6 months' time, it will become 3,64,897. So this is the money he should go and deposit in terms of dollars. But how he's going to do that? He is going to first borrow money in pounds. And how he's going to do that? Borrow in pounds. How much? 3,56,000 equivalent to pounds. Fine. So the spot rate we know is 1 pound is equal to USD 1.5617 bid rate and 1.5673 ask rate. So this is in pounds. Okay. So he is going to convert that into dollars, because he's going to convert the dollars into pounds. So he has a pound rate. So he has to first convert the rate accordingly. So $1 will be 0.6379-0.6403. It's simple formula. We did it in our first lecture. We just do the reciprocal of this first quote, which is pound quote, and take the bid to the ask side and ask to the bid side. So 1 divided by 1.5673 becomes the bid rate, and 1 divided by 1.5617 becomes the ask rate. Here we have to use the ask rate, because here he's converting the dollars. So that means he's going to the bank and buying dollars from the bank. Okay. So the ask rate becomes important. Okay. So which will be 3,56,867 into the ask rate, which is 0.6403. So that means will be his total, pounds converted into dollars. Okay, so that means his dollar will be converted to dollars will be converted into pounds, which will be 2,28,512. Now, what he's going to do? He is going to, borrow this money in basically in pounds. So he's going to pay interest at the rate of 7%. Okay, so this much money he needs to borrow, which we did earlier. So he's going to borrow and he has to pay 7,998 pounds along with the interest. Okay, so the principal plus interest will be 2,36,512. Just to repeat that, we just lost some track here. So what was there? The borrow in pounds. So he had to borrow in pounds. So how much he was supposed to borrow? 2,28,512, which is given the last box. 2,28,512. So he's borrowed the money, and we know the rate of interest in UK is 7%. Okay, he has borrowed for 6 months. So the total outflow on account of pounds for 6 months at the rate of 7% works out to 7,998 pounds. Simple calculations. You can do it on a calculator. So the principal plus interest, total outflow along with the principal and interest is 2,36,510. So this is payable after 6 months. So payable after 6 months is how much? 2,36,000. So in the case of money market hedge, his total outflow is 2,36,510. So now you can just compare the two options. The forward, how much is the outflow? 2,36,102. And in money market hedge, slightly more, 2,36,510. So which option is better? I mean, by some small margin, the forward contract rate is better. So he should take a forward cover to hedge the risk. So in this case, the answer would be that he should be taking a forward contract rather than going for a money market hedge, because that is giving him a better handle, a better, less in outflow on account of pound, which is his home currency. Okay, so now we do 2 more exercises, okay, and then we move on to the MCQ a little bit to see that how much you have followed. So I'll just see if there are any questions. Okay. Fine. So exercise number 6. So just read this question. So X Limited has exported some chemicals worth 1 lakh US dollars from one of the US suppliers. The amount is receivable in 1 year's time. The spot rate is 74 per dollar. The interest rate in India and US are 6% and 2% respectively. Okay, so X Limited basically is an exporter. How the exporter will cover his risk? What is the effective exchange rate? What would be the forward rate after 1 year if the interest rate parity theory prevails? What should be the exporter do if the 1 year forward rate quoted by the bank is 77 points? So there are a lot of questions there. 1, 2, 3, 4. Okay, so let's see that. X Limited will cover the risk in the money market, because since the forward rate is given only at the end, the last listing. So we'll go with the money market cover first. The following steps are required to be taken. Borrow dollar for 1 year. Okay, fine. This is a case of an export. So he's going to borrow the dollar in abroad and bring that money in India. Okay, fine. So this is the money coming into India. So you borrow abroad and invest in India. So borrowing must be such that at the end of 1 year, the amount becomes $1 lakh. Fine. So that means he should borrow $98,039.21. Okay. So that, the amount becomes $1 lakh. Okay, fine. Because then he's going to receive the money, $1 lakh from his customer, which will, settle this loan. So then this 98,000, convert the borrowed sum into Indian rupees at the spot rate, which is 74. So which means it will become 72 lakhs, 54,902. So this sum thus obtained is placed in the money market at 6% to obtain at the end of the 1 year. So that means the money in interest rate is 6% in India. So this money is going to grow to 76,90,196. So sum of 1 lakh received from the client at the end of the year is used to refund the loan taken earlier. So whatever loan he has taken, it has become now $1 lakh. So he's going to pay off this loan through the money he's going to receive from the client. So from the calculation, this money market operation has resulted into a net gain of 2,90,196. How? Because the rate at the spot rate was 74 rupees, and so that means he would have got 74 lakh rupees if the spot rate would have remained the same after 1 year. But he is now getting 76 lakh 90,196. His money has grown to that, so he's making a gain of 2,90,000. Okay, so effective exchange rate 76 lakh 90,000 divided by 1 lakh. So that means he is able to get a rate of 76.90, at which rate he is getting the money from abroad, 76.90. The forward rate as per the interest parity theory is same. Okay, so 74 into 1.06 divided by 1.02. So the forward rate is the same, 1 year. Okay, so we say that if the interest parity theory, prevails, so the rate will be 76. So the forward rate would be 76 as if the interest parity theory prevails. So if we look at the money market hedge and the interest parity theory, it's the same thing. Said in different terms. X should go for forward cover if the forward rate is X should go for forward cover if the forward rate is 77.24. Now, if the forward rate is 77.25. He should go for the forward cover. Why? Because he's getting his money at 76.90. Okay. Since the forward rate which is given in the question is 77.25, so he will be more beneficial if he goes for 70. So look at the question now. So we have answered most of them. So how the exporter will cover his risk? We have seen that using money market. How much is the gain? What is the effective exchange rate? And 1 year if the interest rate parity theory prevails. So that also we have done. What should the exporter do if the 1 year forward exchange rate quoted by the bank is 77? He should go for the forward cover, because in that case it was coming to be 76.90 something. Okay, so he's getting a better rate through the forward cover. So so this is, I'll just stop here so that if you have any questions you can ask me. So now we will, we will go to the exercise number 7, which is almost similar to exercise number 7. So I'll ask you to basically try to solve it. Okay, so I'll give you a couple of minutes. If you can just try attempt it yourself, then I'll show you the answer. So then you can check the answer here. So try to solve this question yourself. I'll just give you a couple of minutes. I'll give you exactly 3-4 minutes so that you can just try to work out the question. So 2 more minutes, please, and then I'll show you the answer. Okay, so this is case of X Limited has imported some chemicals. Okay, so he's an importer, so he has to make a payment. Okay, so the amount is payable in 1 year's time. The spot rate is 74 today. The interest rate in India is 6% and 2% respectively. How should the importer cover his risk? What is the effective rate? What is the forward rate if the interest parity theory prevails? What importer should do if the forward rate is 76 per dollar? So let's go by. So let's use first the money market hedge, borrow in rupees. So this is a case of import. So he's going to borrow money in the home currency and take it out in dollars, convert that dollars and invest there so that the investment grows to the US liability which he has to pay. Okay, fine. So how much he should deposit in dollars so that he can make import payment? So amount payable after 1 year is 1 lakh. So the interest rate in US dollar is 2%. So present value is going to be 98,939. So this much money you should deposit in US dollars so that it becomes 1 lakh so that he can pay off his liability. Okay, so this money is going to bring to India. Sorry, this money is going to actually how much this money is going to borrow in US in rupees. Okay, fine. So he'll borrow in rupees, take it to US and pay off his liability. So how much he's going to borrow? In terms of dollars, 98,000. In terms of rupees, at the spot rate, which is 72,54,000. So this is the money we should borrow in India. Okay, and so payable after 1 year, we will multiply it by 6%. So total outflow will be 76,90,196. Okay, so effective rate is how much? 76.90 because 76,90,196 divided by $1 lakh will give you the effective rate of this thing. So forward rate would be, if you calculate the forward rate as per the interest parity theory, so it comes to the same 76.9019. So if you can see, the money market hedge and the interest parity theory actually says the same thing, but I mean the calculations shows the same calculations. Okay, so if the interest rate parity theory prevails, you will get the same forward rate. Okay, what actually you are using the money market hedge. And if he should go for the forward cover if the rate is 76. Fine. Suppose he is going to make a payment. So if he uses the money market hedge, his total cost is coming to be 76.90. But if he uses a forward cover, he has to pay only 76. So he will be better off if he uses a forward cover. Okay, fine. So now we are going to do all those derivative instruments, okay, which are very, very important. And the most important part and interesting part is this. So forward contracts, future contracts, options, and swap contracts. Okay, so these are the 4 kinds of derivatives which are used by the companies to hedge their foreign currency exposures. Okay, and normally, this should have been the first thing in the morning which we do, so that because these are very well understood, fresh. But let's make a beginning. Okay, I'll just sum up in the again in the next morning lecture when we start these derivative instruments again. So there are 4 kinds of derivative instruments: forward, futures, options, and swaps. And most of your questions in your exams come from these chapters. Okay, so we'll understand one by one the forward contract. Okay, so we'll just go for 10 minutes and then we'll start with the MCQ. Okay, and do this forward, all these contracts, all these derivatives in my next lecture, which will be starting fresh in the morning, so that you can understand in more detail. So let's understand a little bit of them today. Okay, the simplest form of derivative is forward contract. Okay, so the first derivative, the forward contract. It obliges one party to buy and other to sell a specified quantity of a nominated underlying financial instrument at a specified price on a specified date in future. So again, I read, it obliges one party. That means the party, you as a customer, to buy, and other to sell. That means the other party would be normally a bank. Okay, in case of a forward, you see, at a specified quantity of nominative underlying financial instrument. So that means you're talking about 1 lakh pounds or 1 lakh dollars. So it is a specified quantity of a nominated underlying financial instrument at a specified price. So you fix a price today of a foreign currency on a specified date in the future. So that means you're talking about that you will be selling or buying a certain foreign currency in a future date at a certain price. Okay. So there are markets for multitude of underlyings. Now, underlyings here can be basically, either it can be, commodities, it can be currencies, it can be stocks, it can be interest rates. So there are markets of for a multitude of underlying. Okay. Commodities, currencies, interest rates. So these are the various types on which you can enter into a forward contract. But in today's chapter or the following chapters, we will be just covering ourselves for currency and not anything else. Okay. So forward contracts are standardized. So one of the most important part of the forward contracts are that they are standardized. They are not standardized. So where they are standardized? In the futures market, in the options market. When you go to the stock exchange, you will find everything standardized. But when you are in the forward market, they are not standardized. You can choose your own date, place, amount, okay, anything. You can choose, any bank, any institution to enter into a forward contract. So they are not standardized. The terms in relation to contract size, delivery grade, location, delivery date, and credit period are always negotiated. So I go by term in relation to contract size. Now, when you go to the futures market, you'll find that you have a limitation of $1,000, 1,000 pounds, 1,000 euros, 1 lakh yen. So there are standard contracts when you go to the futures contract. But when you go to the forward contract, there are no contract size. You can negotiate for anything, any size. Delivery grade. Now, this is applicable basically to commodities, okay? Because the commodities can be A grade, B grade, C grade. Location, which place you're going to be. Again, it's more relevant to the commodities. Delivery date, when you're going to have the delivery. Either you're going to receive dollars or you're going to, buy dollars or pay dollars. So delivery date is flexible. It can't be on a one day. There's no expiry date as in case of futures contracts. And credit period. So you can have a 90 days, 60 days, 120 days. Okay, but in futures options, normally you have various serial contracts, 1 month, 2 months, 3 months, like this, or a weekly contracts. And they're all negotiable in case of forward contracts. So that's why they are not standard. So that's why they are very powerful tools as compared to future and options, because they are non-standardized. So they have advantages, but they have disadvantages also. So futures and options have more better sometimes, and sometimes the forwards are better. So you have to always find out which will be better for your organization. Now in forward contract, the buyer of the contract draws its value at maturity from its delivery terms or cash settlement. Now in case of forward, normally it is always settled through delivery, but in futures it's always cash settlement. Okay, the value is drawn at the delivery. That means if the dollar has appreciated, okay, and if you are an exporter, your value has gone up, okay, or it's a vice versa. Okay, the value can go down or go up depending on the time of maturity of the contract. On maturity, if the price of the underlying is higher than the contract price, the buyer makes a profit. If the price is lower, the buyer suffers a loss. The gain to the buyer is a loss to the seller. Somebody gains, somebody loses. Okay. So now we'll be doing, one question and then followed by the MCQ. Let me see. Yeah. Okay. So this is a simple question. So we will be doing this question and then we will be having going for the lighter version of going to the MCQs. Okay. Okay, so I know it's pretty, hard stuff. Basically, dealing in derivatives and the currency market. So it takes lots of energy. Okay, but let's do this last bit of doing an exercise, and then we have some MCQs. Okay, some relief for all of you, or rather, we'll go for the MCQ first and then complete this exercise later on. Okay, so just let's go on a lighter version today. So I'm just moving to the MCQ now. So which of the following is not a type of foreign exchange exposure? Economic exposure, translation exposure, transaction exposure, income tax exposure. So which of the following is not a type of foreign exchange exposure? So please answer it. So which should be the right option? Which of the following is not a type of the foreign exchange exposure? A, B, C, or D? So please, you put the answers on the chat line. Okay, so which is not a type of a foreign exchange exposure? Okay, so the answer is D. Yes, the answer is D. And some of the students have answered. Sumit, yeah, absolutely, you're bang on right. Ambika, you're also right. Okay, so let's go to the second one. Yeah, income tax exposure is not a this thing. Today, €1 can be purchased for $1.13. This is a spot exchange rate, forward exchange rate, fixed exchange rate, money exchange rate, or financial exchange rate. So tell me, if today €1 can be purchased for $1.13, so this is this a spot exchange rate or forward exchange rate or any of them? So I'll wait for your answers on the chat line. So the answer is 2A. Yeah, Ambika, you're absolutely right. The answer is 2A. Great. So let's move on to the third question. So the answer was spot rate. So Ambika, you're right. Okay. So third, in an agreement to exchange dollars for euros in 3 months at a price of $0.90 per euro, the price is spot exchange rate, money exchange, forward, monthly exchange rate, or fixed exchange rate. So what is this? Is it a spot rate or money rate, forward rate or monthly rate? So these are pretty simple ones. Yes, Sumit, the answer is A. The answer is correct. Rather, the answer is C here, okay? Forward exchange rate, not spot. In an agreement to exchange dollar for euro in 3 months at a price of 0.9 per dollar. So you are entering into an agreement to exchange dollars in 3 months time, okay? So you are asking someone to give you dollar at 0.9 at $0.9 per euro in 3 months time. So this would be a forward contract and not a forward exchange rate and not a spot rate. Okay. Four, when the value of British pound changes from $1.25 to $1.5, then the pound has appreciated and the dollar has appreciated. Okay, so that means £1 is equal to dollar so much. Okay, so the pound has appreciated and the dollar has appreciated. The pound has depreciated and dollar has appreciated. So which one is the right one? So please answer. So please answer this question. When the value of British pound changes from $1.25 to 1.5, so that means in 1 British pound, earlier you were getting $1.25, but now you're getting 1.5. Has the pound depreciated or appreciated? So Ambika, the pound has appreciated, and Sumit also says pound has appreciated. Yes, the answer is C. The pound has appreciated. Great. So now the British pound appreciates from 0.5 to $0.75. Okay, the dollar depreciates from dash to dash pounds per dollar. So now let me know what should be the answer. Okay, Sumit, Chavi, everybody has given the right answer. Okay, if the British pound appreciates from half a dollar to $0.75, the dollar depreciates from dash to dash pounds. So just open up your calculators and try to solve it. So please solve this question. So answer is C. The answer is B. Question number, okay, 4th is C. Okay, fine. So what's the answer for 5? B, yeah. So Chavi, you're absolutely right. The answer is B. So far, Chavi has answered all the questions. Okay, great. So now we go to the question number 6. The spot rate is a rate paid for delivery within how many business days after the day of the transaction takes place? 2, 3, 1, or 7? The spot rate is the rate paid for delivery within dash business days after the day the transaction takes place. So this is the question number 6, which says the spot rate is paid for delivery. Okay, yeah, Ambika, you're right for your answer number 5. Question number 5, the answer was B, absolutely right. But what about question number 6 now, which is on your screens? The spot rate is the rate paid for delivery within dash business days after the day the transaction takes place. So so can I have the answers, please, on the WhatsApp chat line? The spot rate is the rate paid for delivery within dash business days after the day the transaction takes place. So the answer is 2, 6th A. Okay. So the spot rate is the rate paid for delivery within dash business days after the day transaction takes place. Okay, 6th A, 2 days, absolutely right. Chavi, Sumit, you're also absolutely right. So let's move on to question number 7. Foreign currency exposure can be avoided by entering into forward contracts, buying at spot rates through the process of arbitrage, or none of the above. So foreign currency exposures can be avoided by entering into forward contracts, buying at the spot rates through the process of arbitrage, or none of the above. So I repeat the question. Foreign currency exposures can be avoided by option number A, option number B. Yeah, Sumit has got it right. I think it is 7th A. Chavi and Ambika, everyone doing right. Chavi, answer is 7A. Yes, Ambika, you are also right. Entering into forward contracts. Now, entering into forward contracts is the right answer. 8. The exchange rates quoted by an authorized dealer to its customer is known as interbank rates, merchant rates, commercial rates, wholesale rates. Exchange rates quoted by authorized dealer to its customer is known as interbank rates, merchant rates, commercial rates, wholesale rates. So when you go to a bank or an authorized dealer, so it gives you a rate. Okay, so what is that rate? Is it an interbank rate, a merchant rate, commercial rate, or a wholesale rate? So the answer is B, the merchant rates. Absolutely right, Chavi. You are absolutely right, because the interbank rates are rates between bank themselves for large transactions. But when you go to the bank, so he'll give you a customer rate or a retail rate or a merchant rate. So they're all the same thing. So it's a merchant rate. Okay. So then we go to the merchant rate is the right answer. Okay. So then we come to the 9th question. Dash states that the exchange rate between two currencies will adjust to reflect changes in the price level of two countries. Which theory says that the exchange rate between any of the two currencies will adjust to reflect the changes in the price levels of the two countries? That means the inflation rate. The theory of purchasing power parity, the law of one price, the theory of money neutrality, the quantity theory of money. So which theory says that the exchange rate will be determined because of the inflation in the two countries? The theory of purchasing power parity, the law of one price. So the answer is ninth one. Okay, 9th question. So question number 8, please. Yeah, question number 8 was okay. It was okay. Now I mean we are now on the question number 9. So question number 8 was a little different one. So I think we have seen the answer also now. So we have moved ahead. So the which theory says that the rate of exchange rate will be based on the inflation of the two countries? Is it the theory of purchasing power parity, law of one price, theory of money neutrality, money of this thing? So here the answer is A, the theory of purchasing power parity. Theory states that the exchange rate will be determined. Yes, Chavi, you're right. Answer is A. This theory is saying that it is the prices are based on the inflation rate. So the answer is right. The last question of the MCQ. 1 pound is equal to so many dollars, 1.2679, is a direct quotation of the exchange rate of sterling. Is it a direct quotation or indirect quotation? I mean, answer is it true or false? Is it a direct quotation? So question number 10, 1 pound is equal to US dollar 1.2679. Is it a direct quotation? Okay. So question number 10. Okay. So the answer was A. Yes. Sumit, you're also right. Chavi, you're also right. Ambika is also right for the question number 9. But what about question number 10? The question number 10 says it's a false. Why? Because if you look at the right hand side, what is it? Dollars. So dollar is the home currency. So it can't be a direct quotation in sterling. So it has to, the question answer is false. Why it is false? Because $1 is equal to 1 pound is equal to so many dollars. Or we can say 1 rupee is equal to so many dollars. So it can't be, a direct quotation of India. So similarly, 1 pound is equal to so many dollars is actually an indirect quotation in pounds. Okay, fine. An example would be 1 rupee is equal to so many dollars, which is an indirect quotation in India. Similarly, 1 pound is equal to so many dollars is an indirect quotation. So look at the right hand side. It's dollars. Dollar is the home currency. Okay, so it has to be a direct quote of pound in America. Okay, and not in sterling. So the answer is it is false. Yes, it is false. So Manoj, so Jaipur. Okay, so Sumit said true. No, not true. And Savi said false. Manoj is saying false. Ambika is saying B, which is false. Now, Sumit, why it is not true? Because the same reason I told you that £1 is equal to so many dollars. It's a direct quotation in America for buying £1 because they'll be interested in buying £1. Okay, because suppose they're traveling to say in London or England, so they will be converting their dollars into pounds, so they will be looking for this code. But if the people in UK will find this code be indirect code, okay, because there it will be $1 is equal to so many pounds. As we look at the Indian listing, $1 is equal to 73 rupees because we want to buy dollars, so that is a direct code. Okay, so this is an indirect code, not a direct code. So the question is whether the forward contracts are OTC. Yes, they are over the counter. Fine, the forward contracts are over the counter. The futures and options, okay, they are the contracts which are not over the counter because there you go to the exchange. They are exchange traded contracts. Okay, fine. So you must know the swaps and the forward contracts. They are normally OTC. Whereas the futures and options, they are exchange traded. You have to go to Bombay Stock Exchange or National Stock Exchange, okay, to enter into those contracts. So you don't go to OTC, you don't go to over the counter, you don't go to the bank and don't, make your transactions through either, through telephone or through, going to the place where to the bank. So when you go and visit a bank or make a telephone to the bank and book a forward contract, it's called OTC. But when you do through a web portal, you use an online trading account for entering into a transaction for hedging yourself into for foreign currency risk through a mechanism of either entering into a futures contract or by entering into a options contract. So then it is not OTC, and they are exchange managed contracts, exchange traded contracts. So they are, not OTC, but forward contracts are always OTC contracts. Okay, either they can be done basically through the bank and the customer. Okay, fine. Most of them it is done to do, and normally it involves large transactions. Fine. So any other questions you have? Sumit, if you can ask. So now we will be just doing one question. Okay, before we end the exercise, a very small question. Okay, so please focus. It will just take 5 minutes to complete my exercise. And then we will be doing most of the questions next time, okay, in the next step, this thing, which will be on the 5th of January. So please focus. This question is a little bit tricky, okay, but it's simple, but it involves a little bit more understanding. Okay, an Australian exporter is receiving 5 lakh. Is it 5 lakhs? Yeah, $5 lakh in 1 year's time. Okay, so there's an Australian exporter is going to receive $5 lakh in 1 year's time. Okay, the spot rate is given $1 is equal to $0.7020/25. Okay, so the bid and ask rates are given to you, and the quote is in terms of in terms of dollars, how much $1 Australian will fetch how many dollars. Okay, now 1 year forward margin is 50/45. Now just I have added this line, decreasing numbers left to right means foreign currency is at discount. Normally it would be 45/50, then we simply add them, but when it is 50/45, that means the 1 year forward margin, the currency is at discount. So instead of adding them, we'll minus it. Now the question is, what will be the Australian dollar proceeds if it is hedged? Now he's an exporter, okay, he's going to receive money in terms of Australian dollars. Okay, he'll be receiving $5 lakh, then he'll be converting them through his banker into Australian dollars. So what will be the Australian dollar proceeds if it is hedged? If at the end of the year, the spot rate is Australian dollar is equal to dollar so and so, what would be the Australian dollar proceeds if unhedged. Okay, so that means the first question is use the forward rate to find out what will be the proceeds in terms of Australian dollars. The second is to find out what will be the proceeds in terms of Australian dollars if the rate is given to you is applied and it is unhedged. Would it be what would be the Australian dollar proceeds if it's unhedged? Okay. Would the exporter be better off hedged or unhedged? So there are three questions in one. So let's understand. An Australian dollar exporter will be receiving $5 lakh in 1 year's time. So how much is going to get? $5 lakh after 1 year. The spot rate today is given Australian dollar is equal to so many dollars. The bid and ask rate are given. Okay, he is going to receive. Fine. So 1 year forward margin is also given to you. So this is the spot rate, and he's going to receive after 1 year. 1 year forward margin is given. So now we have to calculate the forward rate. So we will take the spot rate and minus from the spot rate to arrive at the forward rate. So that means 1 year forward rate will be Australian dollar 1 is equal to 0.6970. So which how we have arrived? 0.7020 minus 0.0050. Why we have minus? Because the forward margins are given 50 and 45. Okay. Normally the bid should be higher, ask should be more, but it is the reverse, indicating that the forward rate is a discount. So forward rate in terms of Australian dollars, if you could do, would be 1 year forward rate would be 1 Australian dollar is equal to US dollar 0.6970 bid rate dash 0.6980 ask rate. Okay. So therefore, now since this quotation is in terms of Australian dollars, okay, but he is going to convert his $5 lakh into Australian dollars, so he needs a dollar code. So we'll convert the Australian code to dollar code. So therefore, $1 will be equal to Australian dollars 1.4326 dash 1.4. So this is converting, the Australian code dollar to Australian code. Okay, fine. So by reciprocating, the bid becomes ask and ask becomes risk, the same thing which we did. So US dollar multiplied by 1.43. So he'll look at the bid rate here. He's going to the bank. Bank says, okay, you have brought $5 lakh. I'm going to give you Australian dollars. So he is going to encash the dollars at the bid rate, which is the lower rate. Okay. So he's going to give him 7,16,300 Australian dollars. Okay. So this is, if he was hedged. Proceeds if unhedged. The spot rate we know is Australian dollar is equal to so many dollars. So we are going to convert into the dollar code. So $1 will be equal to Australian dollars 1.42247, 1.42348, and we'll use the bid rate to find out how much it will be in terms of Australian dollars. So he is going to get 7,11,235. Okay, sir, I've got this comment. I really appreciate the way you make this chapter so easy to handle. Yeah, wonderful. That's a good comment, and I want that you should understand it should become very easy for you to solve. I mean, most of the questions which come in the exam, they look to be very tricky and difficult, but if you understand the basics, you'll find they are very, very simple to answer. So now here, the 5 lakh we are going to multiply with the rate, which is the ask rate here, or rather the bid rate. So this will come to 7,11,000. So the exporter is better off if hedged, because if he was using a forward rate, he was getting 7,16,000 Australian dollars, but he was looking at the spot rate after 1 year, he was going to get 7,11,235. So exporter is better off if he hedges himself. Okay, fine. So if he hedges himself, so he gets $7,16,300. But if he gets it, leaves it unhedged, then he is going to get 7,11,235. So I would, ask you all people to, go through this question again. Fine, because this is a little tricky one because the quotes were given. I'll just, because this finishes my, this part of the day today. So I'm just going to, go to the highlights of this question before we end. Now, if you look at, the third column, 1 year forward margin is 50-40. Fine. So this you should be, you should keep focus on that. If it is written, it is in decreasing order from 50 to 45, that means signifying that that currency is on discount. So decreasing numbers from left to right means the foreign currency is at discount. Fine. So, so that is what we did actually while solving the question. What we did was, instead of adding, we just subtracted from the two quotes, bid and ask. So we reduce it by 0.0050 and 0.0045 to arrive at the quote. So 1 year forward rate was will showing now that it is actually depreciated. So Australian dollar has depreciated, fine, in terms of US dollars, because the quote was such. So then we converted that in terms of dollars, because we have the dollars. We are going to get dollars, so we need a dollar quote. So that's why we converted it to dollars, okay, and then multiplied the dollars with the quote, okay, and the quote used for bid quote, because the bid is the price at which we are going to convert our money, our exports, because that's the money that the bank is going to give us, and not 1.4347, because they give us less, okay, as we have explained earlier. So this year is going to get 7,13,000. But if you would have not taken a forward cover and waited for the spot rate, which is given, so we converted the spot rate in terms of dollars and applied the bid rate, and we got $7,11,235. So which means that he's getting more when he was basically using a forward rate rather than leave this unhedged. So so the exporter is basically a better off if hedged. So that covers the topic for the day. And next time we will be covering those derivatives more in detail, and it will really help you out to understand the whole concept. I hope you followed all the questions which we did, and next time we will be starting with the derivatives, okay, all the derivatives, the forward, futures, options. And I'm telling you, you'll really, it will interest you a lot, because those derivatives are very important for you to learn, because they help you in your real life, in your corporate life, and in exams. Of course, they will help you to score more marks. Normally, the foreign exchange question is always a difficult one, okay, and people find it not so easy to handle. But I think with the knowledge you're gaining, it should not be any problem to solve your question in the exams. So, okay, then see you next time on 5th of January, okay, for covering all the derivatives. Okay, bye bye. Good night, and happy New Year to you all.